Hey. Thank you very much for having me this afternoon. So I'm Fred Ursum. I'm one of two founders of a company called Coinbase. Proud to say we're located right here in California, in San Francisco, where, in my opinion, the vast majority of the innovation and investment around digital currency lies at the moment. Likely for many of the reasons that Jerry just mentioned, because it draws a lot of parallels to the early days of the internet. People kind of view Bitcoin as the internet of value transfer. You once had data that you had, a Time magazine article, let's say. Sure, you could get a physical format of that, but then you got magazines online and eventually things like Wikipedia. The same thing is happening here with Bitcoin, not with data, but with value, with money. Bitcoin is, in our opinion, the internet of money. So some brief background on myself. I worked at Goldman Sachs before this. I'm a computer scientist by academic training. Our company, Coinbase, like I said, is located in San Francisco. We've grown it from 2 people to about 60 now. And we're really seen as the leader in the United States in terms of bringing Bitcoin into the mainstream, if you will. So this means having the everyday person reasonably be able to create a Bitcoin wallet, having merchants accept Bitcoin. So amongst those, Expedia, Dell.com uses us for these payments, Overstock, Wikipedia, others. We also really have been at the forefront of regulation when it comes to Bitcoin because we've been living it for the last 2.5 years now. I think that's actually one important thing to understand here as well, is that there's actually been a fair amount of regulation on Bitcoin for a while now. The chief stake in the ground being in March 2013, FinCEN put out guidance specifically on virtual currencies and largely focused around Bitcoin, that basically said if you're doing business in Bitcoin, you have to follow all the same basic rules as if you were doing business in dollars. So this isn't completely the Wild West at the moment. I think that's a common misconception. We've focused quite a bit on exactly these things, specifically on consumer protection and on regulation, because fundamentally we believe that we are a provider of services that deal with people's money, and thus we have a high bar of responsibility that goes along with that. I think that at the state level, what's really important to understand are a couple of things. One, the money transmitter licensing scheme is a good amount of work for a young company to undertake, right? You need to go and get licensed in effectively every single state. That's a separate process for each state, and as a result, it takes a good amount of time and resources. That's something that we've undertaken because we're fortunate to have a good amount of resources being an early and successful company in the space, but others might not be so lucky. You may have seen New York came out with this BIT license recently. I think there are some things that are done well there, specifically consumer protection is well addressed. There are other things which could be better, and I hope that California can set a great example on, specifically regulations around money laundering, where we actually already have a great set of federal guidelines around money laundering that FinCEN, a part of the Treasury, put forward early in 2013, and we've had it as an industry for a while. And ultimately, I think it's actually best if that's left at the federal level. So that's a brief introduction, and happy to be here and answer questions as I can be helpful.
Thank you. Our representatives from Ripple Labs.
We did have some slides we could hand out as well. So again,
I think.
Oh, okay, very good. Thank you so much.
Okay.
Mr. Chairman, committee members, thank you so much for inviting us here today. We really appreciate it.
For being here.
Thank you. So I'm Chris Larson. I'm the CEO and co-founder of Ripple Labs. Ripple Labs is a software company based in San Francisco. We're at just over 100 employees today. About 2/3 of those are engineers. We're trying to bring together a combination of technologists with deep experience in cryptography with financial experts that understand the basic plumbing of our global financial system, as well as regulators. We just added Gene Sperling recently to our board, used to be the chief economics advisor under both Presidents Clinton and Obama. And so what we see that's important about this technology, this distributed ledger technology, isn't so much that there's a creation of a new currency for the world. We actually don't think the world needs a new currency, has plenty of currencies. we think the big problem is moving those currencies around efficiently, either globally or even domestically. So if you look at the way money moves today, we have really a series of closed-loop systems. The U.S. system is actually not connected to the European system or Australia's system or China's system. And the only way that those value or payment systems talk to each other is through fairly antiquated technology and processes like correspondent banking, for example. So the problem with that is, I can literally send a package to Europe faster than I can send money there. So our current value exchange system is very slow, 2+ days minimum. It's actually very expensive for banks in terms of capital they have to put up and fees they have to pay the correspondent banks. There's actually quite a bit of risk in the middle. Payments fail all the time while being transferred. And there's sort of a key lack of competition for foreign exchange and sort of liquidity in our global payment systems. So what we see these technologies for being important today is addressing that need of banks to move value internationally and domestically. So we actually don't think today there's a particularly strong consumer or merchant value proposition. We think there absolutely will be, but we think right now these technologies can actually serve banks as sort of a key missing settlement infrastructure at the bottom of the payment stack. So leaving alone the application layer that banks use, the custodian of asset layer that banks provide, and even the rule setting that NACHA and SEPA in Europe provide today. This would really just address allowing value to settle in seconds instead of days, without the need of banks using an intermediary like a correspondent bank. Banks could settle directly without risk of failure in the middle, and providing sort of new fundamental levels of competition for foreign exchange and liquidity. And kind of stepping way back, we agree that this is the beginning of an internet of value. That is now possible. It wasn't possible before Bitcoin. Bitcoin showed it was possible to do this. Ripple's taking that using a different technology based on the same principles. But the key thing is we think just like the early days of the Internet of Knowledge, going back 20 years ago, that Internet would not have value unless you got the key custodians of knowledge on board, the universities, the research facilities, think ARPANET, Stanford. We think we're in that same period with the Internet of Value, that before these technologies have key utility, we have to get the custodians of value on board first. And those are the banks, financial institutions, market makers. Then I think we're set up where these things can have tremendous value across the board. And so again, the value these things bring are speed of payments, seconds from days, the ability to correspond directly, bank to bank, with much less counterparty risk in process, and with fundamentally more competition for foreign exchange and liquidity for those institutions, which will trickle down to the businesses and consumers that use those institutions. And I'm happy to answer any other questions about our technology or the company. And again, thank you so much for allowing us to be here.
Thank you.
Mr. Chairman and the committee, thank you again, just echoing Chris for inviting us here to speak. My name is Karen Gifford, and I'm the Chief Compliance Officer at Ripple Labs. I'm going to just walk you through a little bit of what we've done in terms of risk tools, in terms of seeing what these technologies can offer in terms of enhanced transparency in the financial system. So if you're looking at the kind of package, if you go to the section that says risk tools, that's what I'll be speaking to. So one thing that I should just clarify technically, and that is reflected in the slides that you'll see, is that the Ripple technology, one of the differences between the Ripple technology and like the Bitcoin technology in terms of transparency just happens to be that the way the Ripple technology tracks information is by account. So you can see, and an account is connected with an account holder, an individual or an entity that's holding that account. So using this technology, we're able to see financial activity by account holder. And that's somewhat different than the Bitcoin technology, which my understanding is tracks funds movement by Bitcoin. So you can see funds moving globally in the Bitcoin technology, but it's by asset moving as opposed to by account. And that'll probably become more clear as we look at some of the tools that we've developed. So the tools that we've developed are based on publicly available information. Anyone could build on top of the Ripple network and build out similar or different kinds of tools. But this is what we've developed ourselves for our own purposes to do our own monitoring and so on of the network. And these tools we use to, when we get a report of suspicious activity or something else of concern comes to us, this is what we use ourselves to look at it. So I'll be walking through 4 different tools that we use, and I'll do it at a pretty high level. And if you have questions, we can return to those, and get into more detail if you're interested. What I will say is that these tools do represent an advance over anything that I've seen before. My own background is, among other things, I used to work as an enforcement attorney at the Federal Reserve Bank of New York, and I did do money laundering investigations long ago, pre-Patriot Act. And one of the major challenges and frankly frustrations of my job was the fact that financial information was so siloed. It was siloed by institution. So if you can imagine you're doing an investigation and you're trying to see where the funds moved, like you think like, okay, something bad happened here and I think it went to this other bank, you had to set a separate subpoena to that bank, have it come back, look at the transactions, and then either go, okay, it did go there, or, oh no, I was wrong. Now I need to send out a new set of subpoenas, look again, try to guess again where the funds moved. One thing about this decentralized technology is, just as Chris was saying, that funds are not siloed in banks, information isn't siloed either. So information is much more available and visible using these technologies than in the current world. So just turning to the first tool called counterparty analysis. This is just like an overview, a visual snapshot of what one account one account activity might look like. And we use this tool to just get a general sense of what's going on in an account. It analyzes that account's transactions by counterparty, by other account that it's interacting with. So in the graphic that you're looking at, the circles represent funds movement, and a green circle represents funds coming into the account, and a red circle represents funds going out of the account. And this lets us identify and track patterns in transactions. And again, just be aware that what we're able to see when we look at this is global activity. We're not looking at, we're accustomed to looking at these types of tools, like, say, at a particular bank. You could see the same type of information, but this isn't limited to that. We can see account activity as long as it's happening on the Ripple protocol. We can see it all over the world. So the next tool is we call degrees of separation. And this is actually, like, for me, my personal favorite tool, given my background of having had the experience of spending weeks and months trying to connect to accounts that I thought were connected with each other. This tool allows us to investigate the associations between any two accounts. So you might think, as an investigator, oh, I think, I see that this money, say, is the, proceeds of public corruption. And I think it went over here. But you can't see, proving that out can be a weeks or months long process as you issue subpoenas and do analysis. Using this tool, you can just put in the two account numbers and see whether they had transactions with each other. And again, because information isn't siloed, you can see it in seconds. So turning to the third tool, which we call flow of funds, this is, again, kind of a good overview tool. It shows funds movement in and out of a particular account, and it's broken down by currency. So in the graphic you're seeing, again, red is showing money out and green is showing money in. So in this particular example, this account is selling XRP. XRP is the asset native to the Ripple protocol, and it's buying dollars. So, and you could see that for whatever currencies the account holder was transacting in. Finally, the last tool that I'll talk about is called threshold risk reporting, and that tool is more designed to give us a kind of global overview of what's happening in the Ripple network. It's not. It can be used to look at individual accounts, but it's much more for sort of looking at overall flows and getting a big picture. So in this particular example, the thresholds are set around XRP balances, and it's divided out by accounts that have gotten global IDs. This is an effort that we have recently initiated to encourage account holders to have identities that will move with them across the network, and then accounts that haven't yet gotten an identifier. So this shows, again, green is funds in, red is funds out, and you can just see the level of activity. And if I had a demo and I could show you this live, you could click on any of these bubbles and see more granular detail. You could set different parameters. You could see things like you could see all the other reports that we've already seen, degrees of separation or counterparties or whatever, and you can set thresholds designed to find structuring. You can set around reporting thresholds so that you can see if somebody's structuring their transactions to evade those reporting thresholds. So that's a very high-level overview. Happy to answer more questions if you have any.
Yeah. Before we go to the panel for questions from my colleagues, Mr. Brown, would you like to add any comments to the present discussion?
Sure. Real briefly, I think everybody who's spoken before me, I definitely agree with. I think the thing that's really interesting both from a regulatory standpoint and from a underlying policy standpoint. I mean, I think our overall objective is to make the movement of money cheaper, safer, and more transparent. And existing clearing and settlement technologies do not achieve that. Most money in the United States is settled for retail payments through ACH, which is a technology that was developed, or a system that was developed back in the late 60s and early 70s. It uses batch processes, spreadsheets, faxes, where a missed number or two can route money to the wrong account, and where it can be then very difficult for the financial institutions that participate in those networks to trace. On a global basis, our technologies are even more opaque. Things like Fedwire and SWIFT, where again, the introduction of a wrong digit can mean that if you initiate a transaction and for, say, $30 million, it can end up in the wrong account, and your ability to get that money back depends entirely on the good graces of the counterparty to that transaction. And when over the course of the last 3 months, there have been some interesting international bank frauds. There was a California money transmitter that was whose systems were hacked and who had $30 million of treasury funds wired to foreign banks. Now, Karen, as a former investigator, knows then you have to go to the registrar to figure out what institutions those funds were wired to, and then issue a subpoena. Hopefully they're within jurisdictions that are reasonably friendly to the United States, and get permission to see where those funds went from. Things like the blockchain and the Ripple ledger would be enormously helpful in creating transparency with regard to global money flows. And the second thing that I don't think that anybody has sort of touched on yet, but that is an innovation that Ripple and the blockchain are part of, is that it this family of things that we call virtual currency technologies, even though I hate that term virtual currency for all kinds of reasons, they're not virtual, they're not currencies, so like putting the two together is like extra misleading, is that it enables the democratization of the development of technologies for money movement, so that you can have developers literally in Africa who are building on top of the blockchain and whose technologies can be incorporated by people in the US, and that creates a mechanism for effectively compensating them for the investment of their time. Like, that's a revolutionary, that's a truly revolutionary idea. To harness the world's talent in a way that the internet protocol doesn't even do. So, so I think people need to look very carefully and thoughtfully, and I applaud the committee's leadership in sort of taking the bull by the horns with respect to the regulation of virtual currency here in California.
Before I ask my questions, do any of my colleagues have any questions for this panel?
Mr. Chairman.
Mr. Sebastian.
Yes, I'd like to hear how the online and in-store retail environment is responding to this new technology.
Sure, I'm happy to answer that. So we service roughly 35,000 merchants, mostly online. I'd say it's the early days of the technology where the cases that matter most for these sorts of technologies are the ones that are most poorly served by current technology. So good examples of that would be I'm paying somebody overseas where I don't have other good options. Or one of the major trends we've seen in technology, especially on mobile recently, is that payment amounts are going lower and lower and lower. You often hear this term of microtransactions, right, where you've very well may see I can pay $1 for this iPhone application now, right? Why not lower than $1? The answer is that current payment technologies just don't really support that very well. The cost to do such a payment over increasingly mobile and digital means by which you're buying things just does not work well. So that's the promise of a lot of these virtual currencies, is that you can actually do things with payments, i.e. overseas or in smaller amounts, or in ways that are completely automated that you just couldn't do before. So at the moment, I would say that volumes amongst merchants are fairly small, but there will be all sorts of use cases, if you will, for payments that these technologies will enable, which prior ones could not.
Ms. Brown?
You know, this reminds me of that television commercial where Bryant Gumbel and Katie Couric are talking about what's the internet with that little A in front of it, and then what's this car we're driving that has no motor? I think I want to ask the question, what happens with all the currency that is in the bank? What happens with all of that?
Yeah, so kind of our view is that nothing changes there. So that really all this is doing is it's probably mostly enabling banks themselves to move their existing dollars, euro, whatever currency they're currently using faster, at lower cost, without as much capital, and at more competitive rates. So it very well might be that most consumers never know they're using this technology, no more than they know they're using some of the backbone of the internet that is there, but they don't have to know about it. They just know that suddenly now I can send $20 to my family in India at practically no cost in 5 seconds at a much better exchange rate than I ever would have gotten. So the banks actually would have new services. The consumer is just happy they're getting a better deal.
So the Bitcoin isn't for a consumer to use?
Yeah, there's a lot of debate around that. I mean, you could certainly, if people want to use that as a store of value, certainly can. I think just like the internet allows you to communicate in any language, I think the internet of value will allow you to trade value in anything of value as you define it.
I think part of the question you're asking is, does Bitcoin or virtual currencies pose a threat to the dollar as a currency? And I think it really does not. Prices are still denominated in dollars. When I go to a store online and I want to pay with Bitcoin, the price is still in dollar. At the moment that I want to pay, the price is converted to Bitcoin so that I can pay a person perhaps overseas who doesn't take Visa or MasterCard because it's not available in their country. But ultimately, we're talking in dollars.
So the Bitcoin leaves my... Could you just take me through
Sure.
so that I can understand it? I'm sorry.
Yeah.
I want to buy I want to buy something that costs $5
Yeah.
that I saw in a magazine, not online, but I saw it in a magazine. How do I buy that item for $5 with using Bitcoin?
Well, there are a couple of different ways you could do it. So I think the way that you're thinking of is that you'd have a Bitcoin account, maybe with Coinbase, like mine, and you'd
Thanks for that.
sure you'd notice that the person who was selling it accepted Bitcoin, and so you would then send them $5 worth of Bitcoin, right? That's if you know the address of the party to whom you're sending money and they accept Bitcoin and you have Bitcoin, that's a relatively easy thing to do today. I'm sure there even exists an app where I could take a picture of the ad and it would happen automatically, or if not, Fred's developers will get on that after the hearing. But I think the other way that that some of us are thinking about the way that Bitcoin might be used is that nothing about the transaction would change from your standpoint. So if you were going to use a Visa card, for example, today you'd go into a store, let's just say Walgreens, and you'd swipe your Visa card, and for $5, because I did this the other day, you could get a pack of gum and playing cards. Because I actually did that before I went and did a little demo class of my class at UC Berkeley. That would cost you $4.95. Now today, that transaction settles between the merchant and you by having the bank that issued your card. In my case, it's a Chase card. So Chase would give essentially $4.90 to the bank that signed the merchant to accept the card. Let's just call it B of A. And since that transaction crosses two banks, what happens is every day Visa keeps this master record of all the transactions that take place in the whole world, and it tallies up. Visa or Chase owes Bank of America, let's just net across all the transactions involving all of the merchants, let's just say $2,000, because they're just really big and most of the volume clears such that there's not much of a difference between those two positions. So what they then do is Visa provides an instruction to a settlement bank, as it turns out it's Chase in the United States, that would then issue move funds from a Chase account at Chase to a B of A account at Chase. They would then provide instructions, most likely to the New York Fed, to make sure that the ledgers for those two institutions were updated to affect the $2,000 credit to B of A relative to the debit from Chase. And you could do that, like the thing that's crazy, right? I mean, like in 2015, that it takes that long and that many steps to move $5 is nuts. Like you could do that. What we're saying is you could do that instantaneously as banks replace the existing technologies with things like the blockchain and Ripple for clearing that transaction.
So, I mean, just to follow up on what you said and Ms. Brown's very insightful question and a little bit of what Mr. Brito said earlier, when you look at this technology, the real goal isn't to replace currency, and that's why you kind of said the word currency is very misleading, is to replace the automated clearinghouse transaction process and other processes within how we move money from point A to point B with seemingly 10 steps in between.
That's right. I mean, that is what I think of as the primary and greatest use case for these technologies. It replaces the pipes that connect banks. It doesn't replace the banks, and it's not going to replace the dollar.
It does anything else. So I think it's absolutely the primary use case that we can see now, but it does a couple of other things. It allows for things that weren't possible before. So it's not replacing anything. It's making new things possible, like microtransactions. If I want to pay you right now half a cent, there's no good way electronically, before the invention of something like Bitcoin, to do that. Now that's possible to do that efficiently. And more importantly, because it's an open network, because anybody can build something on top of it, which I can't imagine what it is. If I could, I would go out and build it. It allows for new innovations that we can't conceive of right now. And that's not possible with existing closed proprietary networks, because you can't just develop for the network. You have to get permission before you can.
Just to further emphasize on that, I mean, that has been a huge problem in financial services for all of history, is that financial services all rely on closed networks where it's very, very difficult to build a new technology. Fundamentally, Bitcoin and other virtual currencies have turned that entire model on its head by saying, actually, this is open source software where anybody can go and build their innovative idea. It may or may not be successful, but just like we had with the internet, that allows all sorts of different people to try all sorts of different great ideas. And ultimately, we're sitting here 15, 20 years later with all these amazing companies that, as Jerry mentioned, you could never have imagined that things like Wikipedia or Uber or Airbnb or whatever it might have been would have existed. And fundamentally, the reason they exist today is because you had an open protocol, like the ones that underlie the internet, that allowed that innovation to happen with a very low barrier to entry. And that's fundamentally what's occurring here.
You know, we do think this is the key thing we can look forward to with this technology. I think, again, right now we're in the early stages, and we think that means pulling the settlement cost down to zero, and we could get there, and moving settlement times down to zero as well. If you get to that state, then you do enable new business models that just simply were not possible before. And you could literally have 1 billion times more transactions, which is what we saw on the internet of knowledge. It didn't just replace phone calls and letters. It created all kinds of new communication. So you can imagine a world where your car has essentially value and maybe is paying the car in front of it to move over, maybe paying it 1/100th of a penny. And you can imagine our devices, maybe our phones, doing most of the payments in the future. So that would open up tremendous new opportunity for banks and anybody involved in value transfer and payments.
The one, I guess my one follow-up question for this last discussion before we wrap up and open up for public comment, unless my colleagues have any other further questions, if you lower the rate of compensation so low within the system because you brought it down to such a small level, what would continue to drive innovation? What would continue to drive the system if there's not at least a small profit margin for those that are kind of pushing the transmission between point A and point B?
It's a great question. So we do see, and we even see today, banks that are using this technology. They certainly could decide to just pass on lower costs to their consumers. You could also, we've seen institutions take it the other way, where because you can send value so much faster, you can actually premium price that. So I think the market will find ways of either, providing more services for a lower cost or premium services, just like I think we saw in communications. We'll see that same dynamic.
Well, I definitely want to take any other further questions. If there aren't any, I will open up for the public question section right now. But I would like to thank all the panelists for this panel and all the previous panels. This really was a fascinating discussion. I really am kind of surprised we covered this much ground in such a short amount of time, but I definitely have a much better understanding. I hope my colleagues do as well on all the topics we covered today, and I know that will help guide us as we have very difficult decisions ahead this year, and as we look forward to working with everyone that was able to come and participate today. So thank you, and we'll be happy to start taking any public comments.
Thank you.
Thank you.
Thanks. Thank you. Okay, well, if there are no further comments or questions, we'll consider this informational hearing adjourned. And once again, thank you everyone for participating.